Bismillahirrahmanirrahim. This is the third video on Introduction to Business Combinations and Conceptual Framework. In this video, we will solve exercises on how to calculate an estimation of implied goodwill, how to estimate a reasonable offering price, how to determine the amount of goodwill included in the acquisition price in different situations, how to compute the total non-controlling interest to be reported in the consolidated balance sheet by applying parent company and economic entity concept, how to determine the difference between the cost and book value by applying the parent company and economic entity concept, and finally, how to compute non-controlling interest in consolidated income and in net assets. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who want to refresh their learning on how to estimate goodwill and a reasonable offering price in case of acquisition, how to estimate goodwill to be included in the acquisition price in different situations, the non-controlling interest to be reported in the consolidated balance sheet, the difference between cost and book value, and finally, non-controlling interest in consolidated income and in net assets. So let us start with solving an exercise on how to calculate an estimation of implied goodwill and how to estimate a reasonable offering price. So large corporation is considering a merger with local company, one of its suppliers, in order to determine a fair offering price. Large has accumulated the following information. We have the total identifiable assets, liabilities, owner's equity, we have the book value, we have the market value. In the last 5 years, local has earned a total of 100,000. Large expects that local future earnings will be close to its average earnings for at least the next 5 years. Normal earning for similar firms during the past 5 years have averaged 10% return on net assets. However, large wants a minimum rate of return of 12%. First of all, we are required to calculate an estimation of implied goodwill and then they estimate a reasonable offering price for large to offer. So the normal earnings for the similar firms is the total identifiable assets minus total assets, that is equal to 150,000, and the earnings are at the rate of 1 minute. Earnings are at the rate of 10%. So 10% of this amount is 15,000. The expected earnings for the last 5 years is 100,000. So the average, we will divide 100,000 by 5 and that gives us 20,000. So the excess earnings of the local is 200 minus 15, that is 5,000. And then the present value of excess earnings, because this is for an indefinite period of time, that is perpetuity. So we are going to use the ordinary annuity table for annuity table for 5 years, and the rate is how much? The rate they want is 12%. So for annuity value for 5 years at the rate of 12%, this will be 3.6047, and that is equal to 18,023. Now we go to part B, the estimate a reasonable offering price. So the future value of the assets is going to be 300,000, and from this we are going to subtract the future value of the liabilities, that is 150,000, and we are going to add the goodwill, that is 18,023. So this is equal to 168,023. So this is the offering price, and the estimated goodwill is 18,023 in this exercise. Next, let us explain how to determine the amount of goodwill included in the acquisition price in different situations. So Hopkins Company is considering the acquisition of Richfield Incorporation. To assess the amount it might be willing to pay, Hopkins makes the following computations assumptions. These are the identifiable assets with a fair value of 6 million, and the liabilities are 3,700,000. The assets include office equipment with a fair value approximating book value, so no change over there. Building with a fair value of 25%, that means depreciation will also increase by this same amount of percentage. Land value of 50% higher than the book value. The remaining life of the assets are deemed to be approximately equal to those used by Richfield Incorporation. Richfield Incorporation pre-tax income for 3 years is 470, 70 and 570 and 370. Hopkins believe that an average of these represent a fair estimate of annual earning for the indefinite future. However, it may need to consider adjustments for the following items: depreciation on building, depreciation on equipment, extraordinary loss, and salary expense. The normal rate of return on net assets for the industry is 15%. And first of all, we have to assume that Hopkins feels that it must earn 20% return on its investment, and that goodwill is determined by capitalizing excess earnings. Based on these assumptions, calculate a reasonable offering price for Richfield Incorporation. Indicate how much of the price consists of goodwill. Okay. So first of all, we go for the normal earning, and the normal earnings are going to be we have the value of the assets as 600,000, 6 million, minus the liabilities, that is 3,700,000. This gives us the fair value of the net assets, and we are going to multiply by the rate, and the rate is 15%. So this is equal to 345,000. Then we have the expected earning of the target, and the expected, we have the pre-tax income of Richfield Incorporation, and that is 470,000 for the year 2011. Then we look into the depreciation, the excess that is there now because of increase in the fair value by 25%. We have depreciation of 380, and 25% of this will be equal to 95,000, and depreciation will decrease our earnings, so we subtract, and that is 375,000. Then the pre-tax for the year 2007-12 is 570,000. We have the same amount of depreciation, that is 95,000. This will be subtracted, so the target net income is 475,000. Then for the third year it is 370,000, and then we have the extraordinary loss, and this has to be added back because this is going to, it is not recurring, that is 130,000, and we are going to subtract again the depreciation on building of 95,000. That gives us 405,000. So the total target 3 years 3 years adjusting earning will be 375, 475 plus 405. That makes 1,255,000. And the average, because this is for 3 years, we will divide it by 3, and when we divide it by 3, this will be equal, that is 1,255,000 divided by 3. That will give us 418,333. Okay. Now we determine the excess earning. The excess earning, the target average adjusted earning is 418,333, and from this we are going to subtract the normal earning, that is 345,000, and that gives us equal to 73,333. Then we have the present value excess earning, and because this is going to be for perpetuity, so we have the earning of 73,333 divided by 20% as is given in the question. So the value is going, this will be equal to 366,667. So the implied offering price will be the fair value of the assets, 6 million, minus the value of the liabilities, 3,700,000, and we will be adding the estimated goodwill, that is 366,667. So this is equal to 2,666,667. Next, we move on to part B, and in part B, they say assume that Hopkins feels that it must earn now 15%, yeah, and not 20% on its investment, but the average excess earning are to be capitalized for 5 years. Based on these assumptions, calculate a reasonable offering price for each field. Indicate how much of the price consists of the goodwill. So we will be looking into both the part on the next slide. The excess earning are not going to change. They are going to be the same, 73,000 73,333. And the present value of excess ordinary annuity is 5 years at 5%. This is already given from the table. You can look into the table, that is 3.35216. So we have 73,333 times 3.5, 3.35 216, and this will be equal to 2,545,825. So the implied offering price will be 6 million, the value of the assets, minus 3,700,000, the fair value of the liabilities, and to this we are going to add, oh, this is an error, this will be 245,825. So we will be adding 245,825, and this will be equal to 2,545,825. Just keep a note that as far as the salary expense and the depreciation on equipment are concerned, they are going to continue at the same rate, and that's why there is no need to make any adjustments about the two, the salary expense and the depreciation on equipment. Next, let us explain how to determine the amount of goodwill included in the acquisition price in different situations. Now, Eden Company is trying to decide whether to acquire Bloomington Incorporation. We have the following balance sheet for Bloomington. They provide information about the book value and the market value. As you can see, we have the current assets, we have the current assets, property, plant and equipment, we have the fair value and the book value, then we have the total liabilities, common stock, then we have the retained earning and the total liabilities and equities. Eden Company expect that Bloomington will earn approximately 290,000 per year in net income over the next 5 years. This income is higher than the 14% annual return on tangible assets considered to be the industry norm. Now, first of all, we have to compute an estimation of goodwill based on the information above that Eden might be willing to pay, include in its purchase price under each of the following assumptions. The first assumption is, so we will look into the assumptions in a while, and before that we are going to look into first of all the normal earnings and the excess earnings. Now, the normal earning for similar firms based on tangible assets, let me clean up this part. So we have the total assets as 1,750,000, and this will be at the rate of 14% normal earning, so that is 245,000. So the excess earning, you can see with the company earning is 290,000 and the normal earning is 245,000. So the difference is of 45,000. This is the excess earning if we acquire. The goodwill is, so first of all now is willing to pay for excess earning for an expected life of 4 years. So if it is, so the goodwill that we have calculated, excess earning is 45,000 and this is for a period of 4 years, so we divide it by 4, that is 11,250. So this is the estimation of the goodwill under the assumption number 1. We move on to number 2. Eden is willing to pay for excess earning for an expected life of 4 years, which should be capitalized at the industry normal rate of return. Now, we have already seen that the normal rate of return for the industry is 14%. So, the number of years in our case is 4. There is an error over here. So for 4 years at the interest rate of 4%, this will be an annuity, is 2.91371. So the goodwill we have already calculated before was excess earning is 45,000 times 2.91371. This will be 131,116.95. Okay, this is for the annuity. And now number C, excess earning are expected to last indefinitely. When it is indefinitely, that becomes perpetuity. So perpetuity is going to be, so again we have the earning of 45,000 and this is 20%. So they divide by 20, and that is equal to 225,000. Then we go to part B, and in part B, determine the amount of goodwill to be recorded on the books of Eden, pay 1,300,000 cash and assume Bloomington's liabilities. So once again we are going to be goodwill, that is equal to the cost less the fair value of the assets. So we already know the net assets in our case, the property, plant and equipment, that is 1,300,000. From this we are going to subtract the total assets, that is 1,750, and this we are going to subtract the liabilities, that is 700,000. So this is equal to 250,000. Next, let us explain how to compute the total non-controlling interest to be reported in the balance sheet by applying parent company and economic entity concept, economic unit concept as such. So park company acquire an 80% interest. So the park company acquired an 80% interest. So when they are acquiring 80%, that means the remaining 20% is the non-controlling interest in the common stock of South Dale Company for 1,540,000 on July 1, 2013. South Dale Company's stockholders' equity on that day consists of common stock, other contributed capital, and retained earning. We have to compute the total non-controlling interest to be reported in the consolidated balance sheet assuming parent company concept and economic entity concept. So first of all, we will determine the total book value of Southdale's net assets. We know the common stock is 800,000. To this we are going to add the other contributed capital, that is 400,000, and we will also add the retained earning, that is 330,000. So this will be equal to 1,530,000. Non-controlling interest, because they have 80, it means they have the non-controlling interest is 20%. So 20% of this amount will be 306,000. So the non-controlling interest in the net assets is 306,000. Then we determine the total fair value again, and in this case we are going to go for the economic entity concept. Under the economic entity concept, interest in the common stock acquired 80% for 1,540,000. So 1,540,000, and they have acquired 80%, so divided by 80%, and this will be 1 million. So the value is 1,925,000, and the non-controlling interest is again 20%. So 20% of this amount is 385,000. So that's how we calculate. And next we are going to determine the difference between cost and book value by applying the parent company and economic entity concept. Now the following balances were taken from the records of S company. We have common stock, we have retained earning, net income, dividend declared, retained earning at the end of the period, and the total stockholder equity at the end of the period as 1,020,000. P company purchased 75% of S company's common stock on January 1, 2011 for 900,000. The difference between implied value and book value is attributable to assets with a remaining useful life on January 1 of 10 years. Required, compute the difference between cost implied and book value applying the parent company theory and the economic unit theory. So first of all, we will look into the part A in this on this slide. So we have the cost of investment and the cost of, let me clean up. So the cost of investment is 900,000 and the equity acquired is 75%. So we have 75% and this will be 700, the common stock of 720,000 plus the retained earning, that is 160,000, and this will be equal to 660,000, and this will be subtracted, that gives us 240,000. Then we calculate the implied value of S company, and this is for the parent company theory. We go now for the second one, the economic unit theory. So we have the implied value of S company, that is 900,000, and this was for 75%. So 100% will be 1,200,000. Now the book value of S company is 720,000 plus 160,000, the retained earning, and this is equal to 880,000. We will subtract this value, that will give us 320,000. This has an relevance as we move on to part B on the next slide. Okay, so we are going to compute the non-controlling interest in consolidated income and in net assets on the next slide. We will continue with this example and just keep this part in mind. So the following balances were taken from the record of S company. P company purchase, all these things are there. Assuming the economic unit theory, compute non-controlling interest in consolidated income. So non-controlling interest in consolidated net income is going to be, again we have the they have acquired 75%, so the non-controlling interest is the balance, that is 25%. So we have 25%, and we have what else? So we have the net income for the year 2013, that is 180,000, and we are going to subtract. You can see the difference was 320,000. This is for a period of 10 years because that is what they say over here. So 320,000 divided by 10, that gives us 32,000. So 180 minus 32,000, and this will be equal, when we solve, this will be equal to 37,000. Okay, then we have compute non-controlling interest in net assets. Now we can see the first one was, we have computed the non-controlling interest in the consolidated income, and now we look for the non-controlling interest in net income. So once again, the non-controlling interest is 25%, and this will be from the total stockholder equity of 1,020,000 plus, now this is for a period of 10 years. So so this is going to be, let me clean this better. So 120,000 plus, this will be 9/10 times 320,000. So when we solve this part, this will be equal to, we can solve 20.25. Where is the calculator? 9 by 20. Let me continue over here. 25% into 1,020,000 plus 9 upon 10 into 320,000. So 25% times 1,020,000 plus 9 times 32,000, that is equal to 288,000. So this is equal to plus 288. Um, 327,000. Okay. So anything else? Okay, that's nice. So this completes our explanation on exercises on the consolidated income, introduction to combination, and the conceptual framework. And I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.